So right now, the market, I think, is still of the mind that we don't have to worry about a recession. I mean, the risks are up a little bit, but, things are all going to work out. Deals are going to be made, and everything's going to be copacetic. I'm just not in that camp. I just think it's time to be a little bit more skeptical of let's buy every dip and it's going to be, nirvana.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to and watching the Financial Survival Network. I'm your host, Kerry Lutz. Well, if you're surprised about what's happened to the market over the past couple of months, you shouldn't be, because you'd been watching this show. You would have heard Jim Welsh sounding the clarion call that trouble was ahead for the market, and you would have at least been prepared. Probably wouldn't have done anything like I didn't, but nonetheless, at least you would have known. So, Jim, what was the real tip-off here back, earlier in the year that made you realize that the markets were headed lower?
Well, there was a combination of things. First was the perception, and it's always great to join you, Kerry, and you're going to be posting a piece on your website that kind of covers some of the stuff that we're going to talk about in greater detail. So I just wanted to put that out there at the beginning. But at the beginning of the year, as you remember, everyone was pretty bulled up that President Trump was going to come in and make a good economy even better. And most people thought that in regards to tariffs, he was using the tariffs as a negotiation ploy and that he would quickly roll back as soon as he got some concessions. And Treasury Secretary Besson gave a speech in early February. And after reading his comments, Kerry, I came to the conclusion they weren't going to be backing down. They were serious about what they were going to do with the tariffs, the trade negotiations, and that meant that the market wasn't prepared for that event. And then technically, what I had been writing in January and February was as the S&P was making new highs, the advanced decline line was making a lower peak. In fact, it had peaked on November 29th. And historically, Kerry, actually going all the way back to 1928, divergences between new highs and a major average like the S&P or the Dow, whereas the AD line making a lower high, had pretty much warned of corrections. Now, if the reason to sell is minor, then the correction is usually 5 to 10%. But if the reason is somewhat more significant, and tariffs fell into that category, declines of 10 to 20%, or even bear markets showed up if indeed the economy ultimately went into a recession. So those are all the reasons. Plus, sentiment was really high and bullish in terms of allocation to equities. And, when you add all that up, it was the perfect cocktail, if you will, for the market to be disappointed and then be vulnerable to selling pressure, which is what we obviously saw, especially during the month of April.
All right. So we had the selling pressure. We had a pullback. It was dramatic, but it really wasn't that severe in terms of pullbacks, was it?
Well, 20% is pretty meaningful. And in terms of the time compression, that makes it even more meaningful. At the same time, the S&P then, off that low, I was expecting a rally, and a couple of weeks ago targeted 5,700 to 5,750 for this rally. So, the impact, Kerry, when you have a sharp decline that is then reversed relatively quickly, the damage psychologically is obviously lessened. But you and I have talked about this. The bifurcation in the U.S. economy is pretty extreme, in the sense the bottom 50% of people have been under the gun from higher prices, higher cost of living, wages not keeping up. And that's in part why President Trump was elected. A lot of people who had never voted for a Republican decided to do so because they remembered back in 2018, the economy was in better shape. They were in better shape. The top 10% now account for 50% of consumer spending. So that has been buttressed by the stock market doing well, housing prices gaining 50% over the last 4 or 5 years. So when we see asset prices start to falter, I think that, again, is a warning that those at the top who have been really carrying the spending load will, at some point in time, start to become more cautious and pull back. I believe that we're in a bear market and that the odds are we're going to see the S&P go back down to the lows that we saw on April 7th at 48.35. And, I just think that the repercussions from the tariff war, the Fed not doing anything, the economy is going to slow. We're going to see unemployment start to pick up. And, when you add all that up together, is the stock market priced for all that? I don't think so.
Mm-hmm. So you don't think the tariff war is ending quickly?
I don't think so. Again, normally it takes 18 months to come up with a trade negotiated deal because there's an enormous amount of detail. So what that suggests is what's going to happen in the next few weeks is the administration will announce agreements in principle. In other words, we've agreed to a trade deal, but now we're going to work out the details. And as we all know, in any legal document, which a trade deal certainly qualifies, the devil is always in the details. So I just think that, what that means is down the road, there's hiccups that are going to happen. I just don't think that unless the tariffs, right now we're at a 10% flat with obviously very high tariffs against China.
Right.
10% tariff is up from 2%. So if we, even with the trade deals, if we stay at 10%, that is a significant increase. And the net result, and I've written about this a lot over the last year, in 1930, Smoot-Hawley was passed and world trade dropped by 65% because everybody else, started to do the same thing. And we actually have seen, Kerry, over the last 5 years, more and more trade barriers, regulations being raised, not by just the U.S., but globally. So the ground is set, unfortunately, to almost repeat some of the experience of the 1930s. Did, tariffs cause the Great Depression? No, but they made the global economy weaker than it otherwise would have been. And I think they made that weakness be deeper and last longer. So I'm not a big fan of tariffs. The longer they persist, I think that is problematic for the economy.
Yeah, well, I'm a free trader myself, but when China, basically weaponizes free trade,
yep,
then you got to do something that maybe isn't for the short-term good of the country or the world, but it has to stop. And, I've been reading about this for decades already. They just ignore the WTO. They ignore all the rules. So it's got to be done. And it's a big excrement sandwich, but we all got to take a bite.
I've never heard that expression.
Well,
I agree with you. To me, it all comes down to the manner in which it's being done. Basically starting with a punch to the jaw, as opposed to you got 30 days to come to the table and come up with an agreement in principle to work out our trade deficits. And if you don't, this is what we're going to do. So I agree entirely that China, since joining the World Trade Organization since 2001, and we urged that. Bill Clinton was very much in favor. Both Democrats and Republicans voted for that to take place. But China has obviously capitalized on that, and to the detriment of not just us, but other trading partners around the world.
Everyone, nobody's happy with them, and especially after COVID, now that we have pretty good evidence that it came from a lab leak there, even though the United States helped fund it, which is a story for another day. But, enough is enough already.
Yeah.
And, it had to end. And, maybe there's a better way to do it. But the difference is that, Trump knows Xi, and he worked on this before. And we're not even mentioning the fentanyl, which for China is revenge for the opium wars, you know?
Yeah. Yeah.
Whole nother.
No, again, all this is warranted. It just comes down to the manner in which they're doing it. At the same time, I think President Trump and his administration understand the clock is ticking. The midterm elections are, 18, 20 months away or something, not that far off. So they need to accomplish an awful lot very, very quickly so that whatever fallout and damage does happen, there's still a window of time where the economy can recover and show improvement going into the midterm elections.
I wholly agree with you. What about Doge? Now, that initially has a deflationary effect because all this money, all the grifters aren't getting paid now, right? So they're in a recession. But and then the federal employees who, basically, I always say a federal worker, government worker is a bit of an oxymoron. But, there's a lot of them that are hitting the bricks. And, in the long run, that is the best thing because they're total parasites and unproductive and destructive going against the country's best interest, right?
Yeah. Again, a year ago in April last year, the General Accountability Office, which was started in 1921, nonpartisan entity, came out with a report, Kerry, and said somewhere between $230 billion and $520 billion of waste and fraud is happening every single year. President Biden did not do anything. And the fact that Elon Musk and Doge are going after a problem that was identified by a nonpartisan entity, to me, should tell anyone who's objective everything we need to know. There is a lot of waste in fraud. And so I commend that because when you start saying, okay, maybe they only found 150 billion, I suspect it's going to be more. But you multiply that by 10 years. So far, $1.5 trillion. So it's very meaningful. And it does send a message to government workers and maybe to politicians who supported some of this stuff and continue to support some of this.
They're all, both sides of the aisle are policing the country here, right?
No question. No question. So I support what Musk is doing. And, sometimes the louder people squeal at something, it tells you something about those people.
Pigs always squeal, Jim, when they're being led off to slaughter. And how could any thinking politician, any citizen of the country have any issue with what's being done there? They're finding, billions and billions, and they haven't even hit their stride yet. I mean, he's only been there 100 days, so that maybe will be his greatest contribution this time around, that he put an end to it and said no mas, right?
Right. And, last time we've spoken before that, Besson has said the goal is to get the deficit from over 6% of GDP, which it was last year and the year before.
Right.
It has never happened in the history of our country where you had a 6% plus deficit during a time when the economy is going 2.5%.
And peace.
Relative
peace. At least not.
So, but when you go from 6% to 3%, that's shaving $1 trillion worth of government spending. So as you said at the very beginning, when you cut back on spending, it does have deflationary effects because the economy is going to grow more slowly when you eliminate that kind of spending. So, again, I think the economy is going to slow more than maybe people expect. The other issue regarding everything that's going on is uncertainty. So there was a survey of CEOs over the last 3 months, and in January, Kerry, 60% were expecting to increase investment, capital spending. We're expected to add more hires and bring more people on work. In the April survey, those were cut in half. Like now it's 30%. So you have a lot of people sitting on their hands, which again isn't great for economic growth. And potentially, if everything gets resolved quickly, then some of that will come on board. But those are all the reasons why, I think the economy is going to slow. And the one thing I want to touch on real quick, the employment report came out and everybody, wow, look at that, 177,000 jobs. No question, it was a decent number, okay? There was, I think, a reduction of 7,000 government workers. So as opposed to the last 20 months or so where
they all go.
I don't know, they're walking the brick somewhere. But my point is, underneath the surface, if you look at the weekly claims report, the length of time that people are on unemployment has continued to increase. So what does that tell us is that companies aren't laying people off, but they have, in fact, as that CEO survey suggests. Yes. All right. And also continuing claims is up over 1.9 million. So it's just validating what we're seeing is that slowly but surely the labor market is weakening. And if the economy slows, the next shoe to drop will be companies laying off workers. Unfortunately, the unemployment rate is a lagging indicator. So the Fed is kind of like stuck. Well, we're going to probably see higher prices, at least for some period of time, from the tariffs. But we're waiting on the unemployment rate to tick up, which I think it will. And they said in the March summary of economic projections that they think the unemployment rate will get up to 4.4 by the end of this year. In April, it was 4.2. So the point I've been making is, yes, the Fed's going to be paying attention to inflation. They're going to pay more attention to the unemployment rate. And if it gets above 4.4, then I think the Fed will feel much more comfortable in moving to cut rates, because it'll be clear that it's warranted, and not because President Trump criticized Powell, but that economic data has shown them that, yep, it's time to cut. So I think that's what's coming. It's just a question of how soon is it going to arrive.
Well, my guess is when you're dealing with Jerome Powell, he's always late to the party, right?
Well, that historically has been not just Powell, but almost every Fed president, because they do wait for the unemployment rate to tick higher. And again, by the time companies are laying workers off, because that's the other reason,
it's already too late.
It's already too late. I mean, employers will resist laying people off. They'll cut hours, they'll do all kinds of stuff because they don't want to let experienced workers leave and go.
Especially.
And so by the time it's like, I don't have a choice, I got to let some people go. The economy obviously already is weakening. Their sales are dropping. They have to do it. So by its nature, monetary policy is conducted by looking through the rearview mirror of our car. And by the time the car is over the cliff, the Fed is saying, oh my God, we're over the cliff. We better cut rates. Yeah. So they're always late.
They're like James Dean in Rebel Without a Cause, right? Where they're having that little game of chicken to see who who can jump out of the car first.
Yeah, well, the last guy to go wins.
Yeah.
Unfortunately, that guy was the last guy, except
he might be over the cliff. He wins.
His name's Butch. I think his name is Butch.
That was it. Yeah.
That's a great scene. It's really a great scene. So
that's like something.
We're dating ourselves.
The Federal Reserve. Well, we always date ourselves. You know that?
All people have to do is look at the screen.
Experience is always about dating yourself.
Yes.
It's not our first rodeo here, Jim, right?
No, it isn't. We have the bumps and bruises to prove it.
Yeah. Yeah. And the higher insurance premiums as well. So
yes.
Yeah. So
all right.
But the market's going to take a hit, but then it's a leading indicator. It's going to see that it's going to look ahead 18 months, right?
Well, here's the thing. People always say the market's a discounting mechanism, that it's looking ahead. And yes, it does do that. But the reality is it often, at important junctures, gets it wrong. I mean, we just saw one. In January, people were looking ahead. Trump is going to make the economy better. Oh, yeah, tariffs are going to make the dollar go up. And what happened? The dollar dropped 10% in a very quick period of time. The S&P dropped by 20%. So for me, Kerry, the idea that markets somehow have greater vision in knowledge than we do, I think is a joke, because that's why contrary opinion, in my view, is a much more powerful thing. So when everyone was bullish the dollar in January, I'm looking at charts and just common sense saying, no, I think the dollar is ready to drop below 100. It was at 110. Oh, the market. Oh, yeah, everybody's bulled up on the market. I think Trump is serious about the tariffs. They're not expecting that. That gives them a reason to sell. So right now, the market, I think, is still of the mind that we don't have to worry about a recession. I mean, the risks are up a little bit, but, things are all going to work out. Deals are going to be made, and everything's going to be copacetic. I'm just not in that camp. I just think it's time to be a little bit more skeptical of let's buy every dip and it's going to be, nirvana.
Yeah, well, the miracle is central planning, right?
Yeah. Miracle with a small m.
Yeah. Yeah, because we've been down this road before. We totally know.
Yep. Yeah. And so one thing you touch on, and again, you're going to be posting a piece I sent you. But one of the things I'm talking about the last 2-3 weeks is positioning in the dollar index has gotten very extreme. In other words, it's just dropped 10% and people are going short the dollar, long other currencies, anticipation that it's going to keep going. And the level of bearish positioning, Kerry, is more extreme now than it was in October of 2023 and any other intermediate bottom over the last year or so that the dollar has made. Plus, the chart pattern, as I describe in that piece, suggests that after the dollar peaked at 114.70 in October of 2022, it went through a big sideways type of correction, down to 110 or 100, 99, up to 107, down to 99, up to 110. I think it's completed this correction from that high in October of 2022. There may be one more dip below the low recently of 97.92. But beyond that, I think the dollar is going to surprise people, Kerry, and rally more.
I agree with you 100%. I'm just expecting it because it's right now hitting resistance. That 100 is massive resistance.
Yeah, it was support. So it makes sense that it's overhead resistance. And so, again, the chart pattern suggests it could have one more drop because the RSI got extraordinarily oversold when it dropped to that 97.92. It was down to like 21. So it wouldn't, that's another reason why you get a bounce to relieve how oversold it is, then go down, make a lower low, and then register a higher RSI level, which then provides a momentum non-confirmation, which in this case is supportive of the bottom.
Yeah, short covering rally.
And that's how it all restarts. Yeah. When you have a lot of people betting against something and they're short, the initial rally is, maybe it's not going to go down as much as we thought. Yeah, so you're 100% right.
Always the case. All right.
Yeah.
So the link is in the show notes. This interview on Financial Survival Network and in the show notes on the podcast, everything else in YouTube. It'll be hooked into my Dropbox. Just tell everyone out there, Jim, how you subscribe and what the deal is. Okay.
Okay. One last comment. If I'm right about the dollar, or you two are right about the dollar, I don't think that's a positive for gold.
Yeah.
So I think gold has a pullback at least to 3,100. I think it possibly could get down towards 2,600. So that's, again, remember in September, October of 22, gold bottomed at 1,600 as the dollar was topping. So remember, it's yin yang, I think, is important. All right. Macrotides.com. If you would like a recent publication, Jim Welsh Macro at Gmail. I'm happy to send out like the May issue of Macrotides or one of my recent, which I publish every Monday, weekly technical reviews.
Yeah. All right. Excellent. Well, hey, if you got a question for Jim or myself, shoot me an email, kl@kerrylutz.com. We answer everything. Jim, appreciate you coming on. Been a while, and we'll talk to you again real soon.
You got it. Thanks, Kerry. Stay well.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.